This is an Uncovered Japan Company research report on SOMPO Holdings, ticker 8630. SOMPO is one of Japan's three mega insurers, but the familiar domestic car and fire insurance label is no longer enough. Its overseas specialty and reinsurance business now earns more adjusted profit than domestic P&C, while its care business gives it a distinctive position in an aging Japan. The investor question is whether that franchise can overcome a real governance overhang. At the report reference date, SOMPO traded at 11.2 times forward earnings, 1.06 times book value, and a 3.26% dividend yield. Fiscal 2026 return on equity was 13.7%. That makes it the cheapest of Japan's big three insurers on book, but not without reason. Investors are weighing one-off heavy earnings, catastrophe and market exposure, and the unfinished repair of SOMPO Japan's governance and claims handling trust. An insurer earns in two linked ways. It collects premiums, pays claims, and keeps an underwriting profit when it prices risk well. It also invests the float, because premiums arrive before many claims are paid. SOMPO reported 5.37 trillion yen of insurance revenue and 18.6 trillion yen of total assets. Its model spans domestic property and casualty coverage, global specialty and reinsurance, life insurance, and a nursing care operation. That mix is the foundation for both the opportunity and the risk. The financial record shows a large and profitable group, but not a smooth industrial earnings stream. Fiscal 2026 insurance revenue was 5.37 trillion yen, and group-adjusted profit was about 535 billion yen. The report also emphasizes why investors should normalize the numbers. Investment gains, catastrophe losses, and policy stock sales can shift reported profits substantially from year to year. For SOMPO, underwriting discipline and the quality of capital allocation matter as much as the headline income statement. The key fact that reframes SOMPO is its profit mix. Overseas insurance produced roughly 294 billion yen of adjusted profit, compared with about 268 billion yen for domestic property and casualty insurance. Its specialty and reinsurance platform brings scale, underwriting expertise, and diversification that are difficult to build quickly. Management's pending roughly 520 billion yen Aspen acquisition is intended to deepen those lines and take the overseas share of profit to about 56%. Integration is therefore a central watchpoint, not a footnote. SOMPO's distinctive domestic option is healthcare and elderly care. SOMPO Care is the only full-scale care franchise among Japan's three mega insurers, while Himawari Life pairs protection products with health support services. Care's approximately 7.9 billion yen profit is small against the group, so investors should not mistake it for today's earnings engine. Its relevance is strategic. It gives SOMPO exposure to the growing needs of an aging population and potentially valuable real-world health and care data. Capital allocation is the bridge between the operating story and shareholder returns. SOMPO is targeting zero policyholding stocks by fiscal 2030 and has raised its cumulative disposal target to more than 800 billion yen. It sold 429 billion yen in fiscal 2024 alone. Reducing these cross-shareholdings lowers equity market exposure, can improve capital efficiency, and helps fund buybacks and dividends when its economic value solvency ratio stays above the roughly 200 to 250% target range. The domestic turnaround is deliberately prosaic. Improve pricing and efficiency. Take the combined ratio from 99.3% toward below 95%, and reduce branches from 253 to 169. The difficult issue is trust. SOMPO Japan received 3 business improvement orders, tied to corporate insurance price fixing, the Big Motor fraudulent claims affair, and a personal information leak. Insurance is a promise to pay when something goes wrong, so governance normalization and consistent claims handling are essential to any lasting re-rating. The peer comparison sets a sensible boundary around the valuation debate. SOMPO's 13.7% return on equity and 1.06 times book value sit below Tokyo Marine's roughly 22.7% and 2.4 times book, and below MS&AD's roughly 17.8% and 1.35 times book. The report's case is not that SOMPO deserves the sector leader's multiple. It is that a narrower valuation gap closure could follow if earnings become steadier, governance normalizes, and capital returns become more predictable. The research scenarios are illustrations, not price targets. From a 26 June 2026 reference price of 6,126 yen, the 3-year bear case is 5,300 yen, the base case is 7,600 yen, and the bull case is 9,600 yen. The base assumes normalized earnings growth and a modest re-rating. The bear case reflects weak domestic underwriting, a major catastrophe or market shock, Aspen integration trouble, or a renewed governance problem. The range makes clear that execution matters more than a single headline multiple. SOMPO combines a growing global specialty insurance platform, Japan's only major insurer-owned care franchise, and an active policy stock unwind. Its valuation reflects a real governance and volatility discount, rather than a simple oversight by the market. The next evidence points are clear: closure of the business improvement orders, Aspen integration, domestic combined ratio progress, policy stock disposals, and the reliability of capital returns. Please explore the full free deep dive at Uncovered Japan. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.